Hey credit warriors, welcome to the show. Now some people say you should never close a credit card because it impacts your credit score. Well, in this video, I want to explore this idea and see what impact closing a credit card actually has on your credit score. And I did a test for you guys by closing one of my Chase Freedom cards. I actually had 3 of them and it just wasn't worth it for me. I never maxed out the quarterly cashback categories, so I decided to close one of them. And we'll show you exactly what effect it had and what I did to minimize the effect on my credit score when I closed the account. So do stick around for that. And this video is brought to you by Smart Credit, but more on that later. So does closing a credit card affect your credit score? Well, yes, it can do. Why is this? Let's look at a few examples. If you close one credit card and then shift the spending that you would have done onto the remaining cards, your overall amount of credit available to you will decrease, but your spending in relation to the amount of credit available will increase. And this increases your credit utilization percentage, which affects your credit score. How can you mitigate harm to your credit score through the credit utilization factor? Well, if you pay all your cards down to 0 before you close your credit card, there will be no change to your credit utilization because, well, it's already at 0. Now, if you can't pay all your cards down to 0, which is probably unrealistic for most people anyway, they will end up reporting balances, not paying interest, but just reporting balances at the end of the month. What you can do is you can make a note of what your credit utilization was before you close your card, and then just have that as the target. Sometimes pay off your cards early, pay off a portion of the balance on your cards early so that you can hit that same credit utilization that you had before you closed your card. I tend to keep my credit utilization at about 3%, which when combined with all the other positive factors of credit that I have, it gives me a FICO score of around 800. Of course, if you're new to the credit game, don't think that just by keeping your utilization at 3%, you can have an 800 credit score. There are loads of other factors at play. For example, the age of your accounts. And that's actually the next factor that we're going to talk about in determining whether canceling a credit card will harm your credit score or not. If you cancel an old credit card account, it will reduce your average age of accounts. Now, there are some differences between the way Vantage Score and the way FICO Score works this out. So don't you keyboard warriors all get on your keyboards like, Credit Shifu said it wrong. No. First, we'll just look at the principles, and then we'll talk about the differences between Vantage Score and FICO Score and tell you whether this is really something you need to worry about or not. So say you have 3 credit cards. One is 5 years old, one is 3 years old, and one is 1 year old. The average age of your accounts is 3 years. But now, if I cancel my 5-year-old card, I now have only 2 credit cards open with an average age of 2 years. Then if I go and replace the one I canceled with a brand new card that's like 0 years, 0 month, my average age of open accounts will drop to about 1.3 years. And this will hurt your credit score. But let's reset the example. If I canceled the 1-year-old account, my average age of open accounts would actually go up to 4 years. This might even improve my credit score, although it would depend on the balance between this and other factors like credit utilization, losing a line of credit on my report, etc. Then if I added another brand new account, my average age would be 2.6 years, so a little drop from the average of 3 years that we were at before, but not as bad as if I canceled my newest account. However, the good news is that FICO, which is the score that 90% of lenders use, still factors in closed accounts when it is working out your average age of accounts, as long as that account still shows up on your credit report. By contrast, Vantage Score, which is the type of score you will see on the Credit Karma website, does not factor in closed accounts. That's why it's called average age of open accounts. They have to be open. With FICO though, you still want to be wary of closing old accounts because it only factors in accounts that appear on your credit report, and a closed credit card account will drop off your credit report after 10 years. So with FICO, it won't affect you now, but 10 years down the line, you might get a sudden shock when that account drops off your credit report. And then it really depends on what your credit activity has been from now until 10 years time as to what's going to happen to your credit score when it finally drops off. In general, it is just best to keep your oldest accounts open forever. Now, I had 3 Freedom cards. One was 7 years, 4 months old. One was 5 years, 6 months old, and the other one was just 3 years old. Now you can probably guess which one I canceled so as not to have a big effect on my credit score. But then there are other factors at play, of course, like credit utilization, the fact that I was losing a line of credit, etc. So in just a moment, I'm going to show you exactly what effect canceling my card had on my credit score. But all this talk of improving credit scores brings me to the sponsor of today's video, Smart Credit, which is a complete money and credit management platform. It can help you achieve your best possible credit score whilst protecting you from identity theft and credit fraud. Smart Credit gives you your 3-bureau credit report and your credit scores. It also shows you different types of scores for different things. For example, credit cards versus car loans. I also like the Score Boost feature, where Smart Credit tells you how to spend in the optimal way on your cards to reduce damage to your credit score, or which card to pay off first to improve your score. For me, my score is so good that paying off my cards won't do that much, but you can see it tells me what damage will happen if I spend on my cards. First, my likelihood of getting approved for new offers starts to go down. Then eventually it gives me a warning that if I keep spending, my bank may reduce my credit limits. But if you have a lower credit score, like on this demo account, you can see that Smart Credit will show you how paying down your cards and in what order will add points to your credit score and increase your future offers. Smart Credit also offers Score Builder, where they take you through an audit of your credit report, and you can see which accounts are having negative effects on your credit score, and you can even have Smart Credit dispute credit report inaccuracies like late payments for you. Smart Credit will either mail or fax directly to your creditors to handle these credit report issues. In addition, Smart Credit offers a money manager where you can view the balances of all your accounts, both credit accounts and bank accounts, investments, etc., and you can track your net worth. Plus, not only do they do credit monitoring on your credit report, but they also monitor your credit card and bank transactions. You can set up alerts to be notified of transactions so you can see if it's not you, and you can stop fraud as it's happening. And on top of that, their $1 million in identity theft insurance will keep you safe as well. So check out Smart Credit to become a master over your money and credit by clicking my link below for a 7-day trial of the service. All right, so these are my 3 Freedom cards, and if you don't know, the Chase Freedom card offers 5% back in rotating quarterly categories on up to $1,500 worth of spending per quarter. You can have as many Freedom cards as you want, so I've got 3 of them. Basically, it's 3x, so it's $4,500 in spending per quarter. I can get 5%, which is also 5x Chase UR points back on. And that means I could earn up to $225 in cash back or 22,500 points in those bonus categories. Only problem is I just don't have enough spending in the categories, or I'm not really that bothered to pull out all the stops to max them out. So generally, I will not max out all 3. I do have a chance at probably maxing out 2, so that's the reason I decided to cancel one of them. And thus, I decided to go for the newest card to minimize the effect on my credit score. That is the Freedom Flex, which it's actually the best card out of the 3. It has some features that the others don't have. But in the future, if I want a Freedom Flex again, I could probably product change one of the others into a Freedom Flex. The only difference is you have to change the card number, because Freedom Flex is a MasterCard, whereas the other 2 Freedoms are Visa cards. So finally, what effect did closing this account have on my credit score? Well, on Credit Karma, which is a Vantage score model, it dropped my score by just 3 points, but it actually lengthened my average age of open accounts. You can see here, it's 4 years, 8 months, because I closed one of my newest accounts, thus lengthening the age. On my FICO score, my average age of accounts is just 4 years, because it still factors in that closed account that had a much shorter history than my other older accounts. On FICO, one of my 3 scores, Equifax, dropped by 2 points, but the other 2 stayed the same. And so there you have it, guys. It really had hardly any effect on my credit score at all. The key points are to try and close newer accounts whilst keeping older accounts open. If an older account is charging you an annual fee and you don't really want to pay that anymore, you can look for product change options. Most cards have downgrade options, and actually a couple of these Freedom cards I got through downgrading. For example, I downgraded the Sapphire Reserve to a Freedom to escape the annual fee. But if you do cancel a newer card, be careful just to monitor your credit utilization and make sure it stays the same as it was before. You may have to pay off a portion of your balance earlier in the month so that your remaining cards do not report a higher balance to the credit bureaus and thus raise your credit utilization percentage, because you've got less overall credit now to work with. But closing the card is just step 1. The real test is going to come when the card I just applied for to replace it starts showing up on my credit report. Since that's going to incorporate a hard pull, which knocks a few points off, Then also a very new account on my credit report, which is gonna shorten my average age of accounts on both VantageScore and FICO. That'll knock a few points off too. And guys, if you wanna see how that goes, I will have a video coming out on that as well. So do subscribe to the channel for new credit and personal finance videos coming out several times a week. A big thank you to the sponsor of today's video, Smart Credit. Do check out their service to master your finances and achieve your best possible credit score. You can get a 7-day trial of the service with my link below. Leave your comments, guys. What do you think about this method? Have you canceled any cards? What effect did it have on your score? I'd love to hear your experiences. I do read the comments, so write something to me down below. But otherwise, I'll see you in the next video. Bye-bye.